So welcome everyone. It's great to have you here. I'm Heidi Hubling. I am CMO for Stubs, Alderton and Markleese, and we do these events every month with a different investor in both the early stages, the Series A stage, Series B, the full evolutionary path for a company to kind of give the startups and the founders in the ecosystem a window into what investors are expecting, how the market is, and give them access to give the investors access to good deal flow that is curated by our partners for them. So we do these every month. And this month we are featuring Michael Rotgin of Shelter Capital. And we'll hear from Michael here in just a minute. They focus on education tech as well as future of work tech. And really, a neat story, and kind of hear some of the background of what brought Michael into the venture capital world. And Alexandra Fryer of Silicon Valley Bank will be moderating for us. So we couldn't do these events without our partners. So I wanted to really quickly go through and have the partners introduce themselves. So I'll tell you a little bit about Stubs Alderton first. Stubs Alderton is a full service business law firm. We do everything from early stage startup venture capital, financings, and incorporations, all the way through middle market M&A. We do tax, we have a litigation department. Intellectual property is a big focus for us, and data privacy. And have a fairly substantial entertainment and digital media practice. We have the Preccelerator program, which Len leads in our Santa Monica office, which offers co-working space, initial capital, and a huge mentor network, as well as partner network to help founders bridge that gap when they're early stage growth, and give them access to resources that can help them in that journey. And I'll have Len introduce himself in just a moment. But first, let's kick off with Anna from TriNet.
Hi, everyone. Hi, thank you, Heidi. This is Anna Evans with TriNet, and thank you all for coming today. I'm grateful to be a part of this group that hosts these events each week. So what TriNet does and what I do is work with early stage startups to help, each month, early stage startups, help them with all things HR. So when you're looking to bring on maybe those first couple of employees and you need to pay them, you need to provide them benefits, you need to stay compliant from a federal and state level, we're going to help you with all of those pieces of the puzzle. We've worked with companies like Snap, Ring, Dollar Shave Club, Netflix, here locally in LA, and would love to work with you in the same way. Thank you.
Excellent. Peter from CMO LA.
I always get nervous when I have to follow Anna, because Anna does such an elegant job of introducing TriNet, and I always mumble my way through mine. But I'm Peter Mansfield. I head up CMO LA. We help early stage companies, typically like pre-seed, post-seed, kind of around that stage, with two things. One is marketing, and the other one is helping them raise money. I focus mostly on financial services and fintech companies. Had a lot of success in that area, and at the moment working with a couple of really interesting ones, one of which I'm a co-founder, called Vertical Finance, that just launched a credit card for wine lovers. The other one's a company called UNES that has taken off like a rocket. It's a savings and investment app for parents to be able to save for their kids' future. So yeah, and Michael, Richard Ramirez, your East Coast outpost for Shelter Capital, used to be my wife's boss, and is one of my best friends. So I'm glad you could join us today.
Very good. So I think I was looking to see if Early Growth Financial is here, and I don't see Dan. So I'll go ahead and give a quick intro for them. So we've worked with Early Growth Financial for a long time. We've been doing this event for going on 8 years. And I would say, so Early Growth Financial is everything for back office finance. So if you're needing access to a CFO when you're an early stage startup, if you're needing access to senior accountants or daily accountants, Early Growth Financial is your resource. And so they're really, really well entrenched in the startup ecosystem, and a great resource for making introductions to capital, as well as other resources that you need early in your journey. And so then I also wanted Len to give a quick introduction before we turn it over to Alexandra for about the Preccelerator.
Good afternoon, everybody. Len Lonzi here, Managing Director for the Preccelerator program for Stubs, Alderton and Markleese. We're located on the Promenade in Santa Monica. We're open for business. Not a lot of people have been coming to the co-working space, but we are open. So if anybody would like to drop in, all I ask is that you let me know ahead of time so we can make sure we have all the right protocols in place and that we're not oversubscribed. We are an accelerator program. We offer capital, we offer legal services, we offer co-working space and a mentor network and a bunch of perks that are available to our cohort companies. We currently have 5 active companies that are working with us, and we admitted 2 right in the middle of COVID in July and August, and we have one that started, God bless them, on March 1st of this year. And if as we've learned all how to go virtual, we've been able to produce our programs and conduct business and help our companies progress in their journey through our Preccelerator program. So for more information, you can reach me at llonzi at stubsalderton.com. And without any further ado, I'll turn it back over to Heidi.
Excellent. Thanks, Len. So I want to turn it over to Alexandra and have her talk a little bit about Silicon Valley Bank and what their offerings are, the full range of offerings for early stage and growth stage companies. And then we'll talk to Michael Rotgin and let him introduce himself before we get into the full fireside chat. You'll have opportunity for asking questions through the chat function in Zoom. And then we'll ask those at the end of the program. So make sure that you're being interactive and asking those questions in chat, and I'll make sure and note those for the end. Also, we've provided, you answered some questions on the intake form when you registered about what your company was and where you are in the fundraising process, and all of that information has been provided to Michael so that if there are companies that he wants to follow up with, that he'll reach out to us and we can make those introductions for him. So without further ado, I will turn it over to Alexandra.
Thanks, Heidi. Happy to be here. I am the portfolio manager for Silicon Valley Bank's Los Angeles early stage portfolio. And Silicon Valley Bank, we've been around for about 35 years, working mostly with venture-backed companies as well as the VCs who invest in them. And we offer a range of products all the way from inception up through acquisition, IPO, corporate stage, and everything in between, including a private bank for founders as well. At the early stage, for earlier stage founders, pre-Series A, which is where I focus, we are sector and niche agnostic in the innovation and tech space, everything from life sciences to robotics, e-commerce, and everything in between. And we offer free checking accounts, savings accounts, credit cards, wonderful content for founders to connect with each other in an ecosystem as well as investors. And then as they scale and grow, we offer everything from venture debt lending to more complex financing options down the line. So we try to just be a partner from the beginning to end cycle of a startup company and help founders grow through that process.
Excellent. And Michael, do you want to go ahead and give a quick introduction of what you are, or who you are, and what Shelter Capital does, and what they focus on, and then we'll circle back to Alexandra.
Sure, terrific. Well, thanks for inviting me to speak, and I hope I have something interesting to say. So I've been doing venture since about 1999. And prior to that, I was a corporate attorney back east in New York and in DC, first in New York, then living in DC and working in New York and commuting. I represented clients from across the spectrum, from early stage growth to large public international clients in all sorts of domains and verticals. But what I really enjoyed was representing the early stage founders and the early stage companies, and really getting into the collaborative dialogue and work with them. Prior to that, I worked for the federal government in an economic policy capacity. I worked for the Senate Banking Committee and for a presidential transition under an economics cluster. As I said, I started venture in '99. Always with an early stage focus, which is what we do today. We're predominantly early stage investors. We get in early, we're active, we're not passive. We don't get involved unless we think we can bring value to the table, unless we think we'll enjoy working with the company and the founders. We do, because we're nimble and we're able to act quickly and we have flexibility, we do some opportunistic investments. So I'll say 80% is early stage, and then we will do some later stuff and go all the way up the capital structure. Today, we focus predominantly on ed tech and workforce development, which is a broad category and includes a whole host of education, talent, a large array. Although in the past, we've had a lot of different verticals that we worked in. We've had semiconductors, enterprise software. We still do data analytics. We have a number of life science and healthcare, health tech companies today. The space we really like. We don't have the internal expertise, so we'll do those with partners that we trust. That's pretty much an overview of where we are today.
Okay. Well, I'm going to hand it over to Alexandra and let you take it from here.
Great. Thanks, Heidi. So Michael, you touched on this briefly, and how your career and your focus has changed over time. I'd love to hear a little bit more about what led you to specifically focus in education and workforce. What is it about those two specific niches that that you're really passionate about, and how has your earlier career really led you to that pathway and that focus?
Yes, as I mentioned, over the years, we've invested in a lot of different spaces. We've always had an interest in education. In the last number of years, as we've really recognized the broken system and the need for change. It's something where we have personal interest, where we think society really needs the change, and we saw a lot of opportunity. Clearly, there are problems in the workforce. As technology and digital transformation has displaced a lot of workers, and the speed of that accelerates. The education system is archaic and it's extremely broken, and it's not preparing people for the workforce and for the changing workforce. So this disconnect has created a fair amount of problems, but also the opportunity for change, and from an investment thesis, the opportunity to find some good investments. It's been said that the education system is old and unfortunately resilient, and it's really true. You've got a lot of entrenched, outdated approaches. It's interesting because COVID is clearly accelerating the needed change that everybody's understood has to happen, but there's really been no impetus to force it. And maybe we can talk a little bit about that as we move along. Mm-hmm. One of the big problems with the education system is it's failing not just itself, but its students, right? Students, as you get into the higher ed, it's expensive. Students leave with a tremendous amount of debt, and if they can't have demonstrated return on that investment, they're just not going to do it. And you see that with a lot of the traditional four-year colleges. They're losing business, they're dying. We've seen a tremendous amount just fail in the last couple of years, and we've seen the trend and anticipated a lot more happening. We think that's even expedited more now because of COVID. So the educational systems know there's a problem, and they're ready for change. The community colleges have typically been a much better place for this. They're teaching towards vocational skills. The employers really want to know that they're hiring people with a skill that can hit the ground running today, and the four-year institutions aren't really doing that. Technology is at a point where a lot of these legacy issues with the education system can be changed. We have the ability to do so, and the schools are recognizing it. The employers, who are arguably the end customers of the educational institutions, since they need to employ the students and for the students to get a return on their investments, are recognizing it. And so you're seeing more money flow into the space now. You're seeing the businesses invest more in trying to fix the problems. And this has given rise to a really interesting investment environment for us.
No, thank you for that. And I will touch a little bit more on that later, and kind of the future of education and workforce and where you see the biggest opportunities. And from an investor standpoint, and your style of investing and your style as kind of an advisor and operating partner, what is your investment philosophy at Shelter, and how has that shifted over time? You've been there for a long time now, and how has your personal investment style shifted over that time frame?
Yeah, so we've always been early stage and we've always been active. We don't normally just invest on a plan. A company could be pre-revenue, but we like to see a complete team and real product development. We roll up our sleeves. It's not our model, it's not ideal, but we've stepped into operating roles at the portfolio companies when necessary to fill interim needs. It's against my better wishes and judgment, but I've taken on the roles of interim CFO and interim COO. It's not the best use of my time, but we're there for the companies, and we try to help in any way we can. And that's just indicative of the type of value we'll bring to the table, outside of the Rolodex and the experience. It's a real partnership. As I noted before, while we've had all these different verticals today, you ask how my philosophy's changed. Well, I think you really need to get a deep, narrow focus today, especially at the early stage, to bring value to the table. It's not to say that generalists that are early stage investors or generalists that focus on consumer goods don't have a skill set and can't bring value. But from my perspective, being a dilettante and knowing a little bit about a lot of areas is a lot of fun, but it sort of curbs a lot of the value you can bring. So we decided about 4 years or so ago to really get deep into the space that we were enjoying the most and we saw a lot of opportunity, and that was predominantly education and workforce. And as I said, workforce is still a broad area, as is education. It's assessments, upskilling, active learning, skills matching, talent acquisition, learning management systems, engagement, credentialing, and maybe we'll get a little bit more into the discrete theses in those different areas as we go along. But you can still develop sort of a focused niche in those areas, and you can establish the relationships, and you can understand the ecosystems better, the competition, and I think that brings a lot of value to the table, especially at the early stage. At the same time, we're investing in data analytics platforms. And as I said before, other opportunistic things, just because we're small and we're nimble. We played much higher up on the food chain. Obviously, we take a smaller piece and we're not active investors at that point. But we're still investors. And when there's opportunity, we're going to play it. We've dabbled a bit in the SPAC markets now and in a bunch of other areas.
For sure. No, that's really, thank you. And, I know when we chatted last week, we talked a little bit about your philosophy too around kind of creating and creating the investor makeup of a round, and how you prefer, not to be a sole investor at the early stage in a company. Can you talk a little bit about why you think it's important to have multiple investors and what your philosophy is behind that?
Yeah. So in my opinion, there's a whole host of reasons, both for the investor base and for management, to want to bring in a diverse pool of investors. The first step is determining the right aggregate amount of funds that the company needs to raise. But then you need to determine where those funds are going to come from. While we're very comfortable leading a round, we don't need to be or want to be the only sophisticated money in the round. It's really hard to build a company, and we have expertise in certain areas that we discussed, but clearly others have other complementary and synergistic expertise. The more that you can bring to the table like that, especially at the early stages, the more beneficial it is to the company. So we'd like to see, different groups that are complementary and synergistic. And it's also just helpful as you move along. We've been through cycles. We've been through those bad times. When I first started out doing this business, I had a smaller fund, and we invested under a thesis of giving a certain amount of money to take the companies to the next point to reduce dilution. But often we were the only investors at that point. And when things got really bad and we had to continue to support the companies, we had to make the hard decisions. Obviously those that were doing great were the ones it was easier to support, but even those that deserved continued support, we might not have had the means to do so. So it's nice to have others to share with that around the table. From management's perspective, I think there are a host of reasons why it's nice to have a plurality of investors. It's difficult to run these companies, and there are always going to be difficult conversations. And when you're having a conversation with one person, or the board is made up of the founders and one investor, and there are disagreements, often gets personal, and it's often hard to accept. If there's a plurality of decisions at the board level, the shareholder level, even if the founder doesn't get the decision that they're looking for, it's a lot easier to stomach it when you have two unrelated, intelligent parties with differences of opinions. So I think just for a healthy environment, that makes a lot of sense. Also, from the financing perspective, it's important. One of the first things I do when I look at investing in a company that has subsequent rounds is to understand the cap table and understand who's participating going forward in the new round that I'm being asked to participate in. I'm going to spend a fair amount of time digging through that. And yes, there, especially at early stage, there's a lot of friends and family who only make first investments and who don't continue on, and you expect that. But when I see sophisticated money not continuing on, that raises a lot of flags. And there could be good reasons. There could be internal problems at the fund. There could be, just opportunities to use the cash elsewhere. But if they're not investing, I'm really going to wonder why. Now, if you only have one investor and they're not investing, that's a red flag. And while I might be able to get over it, there are a lot of good opportunities out there. Am I going to want to spend the time trying to get past the red flag? It just creates too much friction. So I think those are reasons that management should really consider not taking in money from one source, regardless of it that one source is giving a higher valuation. There's a lot of value to having a syndicate at that point. But that being said, I think it's incumbent on management to spend a lot of time to make sure that that investment syndicate, that the partnership of investors, can really get along and not create problems. And that's on so many different levels. First off, management should be diligencing the investors the same way investors diligence management. Check with companies that have succeeded, check with companies that have failed and how those relationships work, check with companies that have had to pivot, understand how the specific partner and the specific representative from the investor who's going to be working with your company has worked with others, and make sure that that's a style that you can work with and deal with. Similarly, make sure that they can work with each other. I'm not saying get investors who have always done deals together, but get to know them. Again, it's a dating process. Get to judge the personalities, understand the characters. There could be nothing wrong with two people, but they might not get along together in a good working relationship. And it's incumbent on management to really spend time. They may not be right, but at least they can try to do it. And then there are considerations of life cycle of investment vehicles, right? So if one investor invests near the end of their life cycle, and another investor, it's their first investment out of a fund, they may have different philosophies or approaches to when they need to liquidate this investment. And that's going to create, a lot of trouble at the company, at the board level, just because there's disagreements on how to run it and how to exit it. So you want to spend a lot of time trying to make sure that you get an investor group that can work well together, and that there aren't, factors that may create problems down the road. And to the question you asked, you do want to, in my opinion, have multiple investors for a host of reasons.
No, that's really helpful. And I think, often the conversation with founders is around how investors are doing their diligence on founders, but it's just as important for the founders to really be disciplined in their understanding of who they're getting into bed with for the next, so many years throughout the life cycle of their company, especially at the early stage, where that's a very long and in-depth relationship. And, on that point in, kind of doing your diligence on companies and management teams, how important is the founding team to your decision to invest? What do you look for? What are some of the qualities and characteristics and virtues, as well as the kind of makeup of the team that you'd like to see when you're beginning that process of investing?
Yeah. So management team is extremely important. It's probably the most important thing. And it's cliche, but it's cliche for a reason, right? I'd rather invest in an A team with maybe less than an A idea than a B team with an A idea. I'd rather invest in an A team with an A idea, of course, but the team is much more important at the end of the day. They need to have the ability to execute. They need to be able to pivot, which, as we all know, happens quite often. They need the right temperament to work with the investors, and they need some relevant domain expertise. It doesn't necessarily have to be everybody having the domain expertise, but when you have a whole team of smart people who have an idea but haven't really spent time in that industry, it's really difficult. You know, for instance, in the education space, we've seen a lot of interesting plays from smart people, but they didn't understand the sales cycles or the selling process, because they are unique in the education space. So that domain expertise is also quite important. We'd like to see a pretty complete team for a company at the stage that we're looking at. So one of the first things I'm going to do is ask for the organizational chart. I don't want to just see the details on the roles that are filled, but I want to see what roles are missing. I want to understand the timing and the plan to fill those roles. It's not that we won't, but I'm very hesitant of taking the risks of filling known gaps, especially at the higher levels of the organization. We've done it, we will do it, we have done it, but it's a hurdle for us. We like to know who we're getting into bed with. And that doesn't mean I won't spend time with a company and speak with them over months, and maybe I'll help them fill those roles before we make the investment, before we pull the trigger. But that's really important. And then it's getting to know management. And we spend a lot of time in our diligence getting to know management. This is a true partnership. It's like a marriage. There's a lot of good times, there's a lot of bad times, there's a lot of trench working. You've got to know that you can trust and get along with the management. Again, it's not always right or wrong, but everybody's got different styles, and your styles have to mesh because it's got to be such a good working relationship. One of the problems with COVID, and is the lack of in-person ability to do so. Yes, you can do so much over Zoom. We're doing it over Zoom right now. I spend all day jumping between Teams and Zoom and Meets and all of that, and we do it, and that's great when I'm getting substantive factual information. But you still really can't get to know somebody the way you do when you have multiple meals with them, when you're spending time getting to know them as people. And it's important for me to know that, besides getting to know their character, getting to know them as a person. I want to know about their family, their interests, their hobby. I want to be able to have a talk with them because I want to be friends. And I want them to know me the same way and feel the same about me. And it makes it a lot easier for them to be transparent at that point, not just before the investment, but especially during the investment. You can pick up the phone and have a chat with a friend and say, hey, we're experiencing this problem, or we anticipate this. You do that much easier than you may call somebody who you don't have that relationship with and you're not comfortable saying what types of problems you have. And from my perspective, the earlier I know about issues, the earlier we can all roll up our sleeves and try and solve them before they sort of get out of control. So getting to know them as people is really important, and getting to build that relationship. But the diligence process in and of itself is not just about dotting the I's and crossing the T's. Obviously, that's tremendously important, and that's number one on the checklist. But I'm not always looking for the answers to the question. I am looking for the answers, but it's not just the answers I want to the questions I ask. I want to. It's how their answers, how they're dealt with. The exchange, whether somebody's trying to pull one over on me. If they're exaggerating, if they're obfuscating, if they're trying to sell you, it's not going to change after the investment's made. And the tendency for founders is often to try and sell. That's what they want to do with their product, what they want to do with the service. Great CEOs are sales guys, but I don't want to be sold. And I'm going to spend enough time that it's going to be hard to sell me. And that's just going to make the opportunity fall apart, even if everything else is going well. If I ask a question and I get a non-response response, I'm not just going to take that as a response and walk away. I'm going to see if the answer responded to my question. I'm going to ask it again, and I'm going to ask it again. And the more times I ask the question, the more times I don't get a real answer to that question, I'm either going to, one, think the skill set's not there, or somebody's trying to hide something. Neither one is going to be positive for me when I'm, writing down my pros and cons lists. If you exaggerate, and I'm just giving examples that I see a lot, And I'm not saying that every time I see it, the intent is bad and somebody's trying to play a game. So, I'll use these examples as worst case and don't take it as though that's how everybody acts. But, people like to talk about their potential partnerships or their large customers and the extent of those talks. I'm going to look into those relationships. I'm going to make the phone calls. I'm going to dig into it. I'm going to want to see the contracts or the term sheets. I'm going to want to validate what's being told to me. And, often it turns out to be puffery. And again, don't sell me, give me the truth, because again, we're going to be partners here. So that's a negative sign if I see that during the diligence process. Financial models, I spend a lot of time with the financial models. I asked for the org chart, I asked for a financial model. Don't give me a static PDF without the underlying methodology or the assumptions or the formulas. And yes, it may be innocent that I get it and I'll ask for the model after that, but frequently I'll see resistance to giving the model, and maybe it's because they're trying to hide something. Maybe it's because they only have the top level answers and they've done that in an ad hoc, jury-rigged way because they don't understand the market. And let me be clear, there's a lot of times where you can't understand it because you're treading on new territory. There's a lot of times where there are leaps of faith you have to take because you don't know it. That's fine, but don't hide it from me. Let's talk about it. I'm going to want to trace the model and understand the assumptions and go step by step. Don't hard number something that shouldn't be hard numbered. Again, these are all just red flags as we're doing the diligence process, but they also help me understand management. The best management are the ones who I'm meeting with the first couple of times and I ask a question and tell me they don't know. That's great. You don't have to know everything. Just because I ask you a question, don't make it up. I don't know, but maybe this or that, or maybe you guys have expertise. That's why we're coming to you as potential investors. We don't know that. That's honest. So the integrity and the honesty are significant things I look for during the diligence process.
Definitely. That's really helpful. And I think, the basic guidelines are just, transparency, honesty, and, even teachability too. And being able to shift and pivot and change with your investors and advisors. No, that's really helpful. And I know you touched upon briefly the financial models piece. And I know last time we talked, we discussed, what your typical check size is and how you look at how much you choose to invest in companies. And I'd love to hear a little bit more about your suggestions for the founders on the line about how they should look at their check size that they're requesting, how they should approach fundraising, and how much money is enough money. And also how you view founders in the check size that they ask for. And we've talked, you mentioned a really wonderful term called discipline of thought when we talked last week about how founders, look at financing and their financial plans. So I'd love for you to kind of elaborate on that and discuss a little bit more.
Yeah, sure. So, and just taking a step back on discipline of thought, and it flows into, I think, where the conversation is going. It's just not discipline of thought in how they think about the financing. It's discipline of thought of how they think about the whole company and the business. So I'm a big proponent of having an investment plan or a business plan document, whether it's only meant for internal purposes or otherwise. Yes, I'm going to want to see it as a potential investor. But I think an organic living document is really beneficial to the company and the team. It allows you to put the thoughts down and really articulate how you're going to go from A to Z, including the specific steps in the middle, B, C, D, et cetera, et cetera. Oftentimes, people, myself included, will have the idea in our head and we think we know how to do it. But until you actually take the discipline to articulate it and put it down, you may miss some of the steps in the middle. You may miss L and N, O. And that could prove to be a fatal gap because you hadn't thought through something that really is difficult. So I think having that document is really important. It obviously influences the financials, but just from a general how the business is going to run, how we're going to build it, how we're going to get from this milestone to that milestone and what needs to be done. That way the whole team's on the same page, or at least they have the ability to be on the same page. They could look at it and disagree. And it's good to know that when they know it, because the discourse that raises is really important too. And somebody may decide it's the wrong approach and they don't want to be part of the team, or they may have a better approach and it can be deliberated upon. So I think as part of discipline, having that document is a very important step. And to flow into the question with that, potential portfolio companies will come looking to us when they're doing a raise, and I'll try and figure out what the right amount of money for that raise is. And the first question is, how much do you need? And I'll get 3 different types of answers. I'll get a discrete answer, we need this amount, okay, and where does that take you? And where, both in terms of development and time? Good answer. I'll get, well, if I had X amount, I could do this, and if I had Y amount, I could do that. And right off the bat, that sends up a flag to me. The investor or the portfolio company should be asking for the ideal amount of money. Doesn't mean they're going to get it, and doesn't mean there's not going to be dialogue and discourse with the potential investors, but they should have an understanding of what they need and why they need it, not what they could do with X amount. It may come down to that at the end of the day. They may only be able to get X amount and may be able to come up, approach it from the other side and get it, but I don't think that's the right approach. So I often like to go through an exercise with the companies. Okay, you're raising your first round of money and you're determining how much you want to ask for. Okay, well, let's look at the business plan we talked about, and let's figure out where the inflection points are, where the company's valuation changes, where you have a significant jump. And let's mark that as the first milestone. You want to raise your next amount of money after you increase the valuation. So to the one round subsequent to what you're coming to me for, think about what type of investors you want in there, and maybe even specifically which investors, and get an understanding, do the research of what they're looking for in their investments, what milestones they want the company to have reached, what metrics they want them to show, what performance metrics and ratios, whatever it is they're looking for, understand that, and then superimpose that on your business plan and your timing and where your inflection points are, and say, okay, for me to get from today to where somebody else will want to put in money in the next round, that's series, let's call it from seed to Series A, that's Series A investor, I need to achieve these goals. Well, now I've got my business plan and I know where that point is, and whether that's 12 months down the road or 18 months down the road, I know that if I achieve, or I believe if I achieve these, I'll be able to raise that next round of money at the valuation that's good for me from the type of investors that I think will be helpful. Okay, so now build in a bunch of cushions, right? You're going to have execution risk. Things aren't going to go as you plan, whether it's internally or externally. There will be changes in the market for whatever reason. And there may be risk of hiring the right people that you need right? Although I talked about the importance of a full team, that team is going to grow over time. And as you're hitting those milestones, you're going to need to add to the team. So could build in a cushion for that, but understand what you need to do. Then you're going to have time to shop the deal and for somebody to do diligence, and time to document the deal. Put in a cushion for that, and then put in another cushion because we don't like a company to run out. And that's sort of a magic number. But then take it a step further and say, okay, from the Series A to the Series B, I'm less sure, but here's what I think it is, and do the exact same exercise so that you can take that back and understand the amount that you need for the Series A to make sure that the Series A investors that we're talking about are there to give you that type of money, because you may have to rejigger the whole thing if you need too much money in the Series A to get to the Series B than you think is viable. And take that back, and that's sort of the number to start it. Here's the ideal number. But remember, when you're getting from seed to A, you're also saying, how you can build this, what can be done in serial, or in parallel, what has to be done serially. All those things are factors in it. But now you've come up with a number that has a rational basis. I promise you it's going to be wrong. It's not going to be right, but there's some thought to it, and the thought makes sense. And now you've articulated it. And now each week as things change, you can change because you know what needs to be changed because you have that roadmap. So that's an exercise that I really like to see the portfolio companies do. There are other ways of getting there, and somebody may come to me with a great model that shows what they need. That's wonderful, but this is something I've always found helpful. And you asked also, about our size. Well, when I started doing this, to start a technology company, I'm not talking about running it, just to really get it off the ground, was millions of dollars. And that number has really declined to several hundreds of thousands of dollars now. It's attributable to a host of cheap tools for innovation, for high-powered, inexpensive computing, cloud computing, off-the-shelf software, open source software. It's just less capital intensive to do that. And that's sort of why we shifted our model a bit. So our initial check could be, as low as a couple of $100,000 to multiples of that. It all depends on the company. But the first step is determining how much they need, then determining, as we talked about earlier, the mix of investors, so you get that plurality of investor base. And then we'll sit around the table and figure out what the right check size is. But we don't go into these as a sort of a one and done. The intent is to continue to support the companies throughout their additional raises. One, as I mentioned, you always want to show continued support for your companies to attract additional investors. But two, we want to double down again on the companies that are doing well. And so we're always going to insist on, at a minimum, preemptive rights. And depending on the circumstances, if we get in really early and what we're doing warrants it, we might push for a super pro rata right to give us the ability to really play going forward.
No, that's really helpful. And it's interesting to see how that has changed over time, and how check size and the financing needs have changed over time. I want to be mindful of time, so we have time for the folks on the line to ask some questions, but I do have one more question for you, and to kind of give you the space to geek out on education and workforce. And I would love for you to kind of talk a little bit about, especially as 2020 has had such a big shift in for education and workforce because of the pandemic, socioeconomic and political climate changes. In the future, where do you see the most opportunity for technology within education and within workforce? And do you, what are some of the biggest gaps, and where do you think technology can kind of fill and help, meld those gaps together?
Yeah. So, as we talked, the current system's broken. It's been broken for a long time, both from the workforce and the educators, and they are sort of inextricably linked, right? So the workplace is evolving at a dramatic pace, and that's creating challenges both for working and for learning. The traditional jobs being displaced due to automation. You have the gig economy growing. I focus on three constituencies. I focus on the employers, the employees, and the providers of the education. They all need to work together, but each has different needs and different problems that they're trying to address. The employers are really concerned that when it comes to hiring, that they're not buying the right assets to match the needs. They also want to make sure that when they do hire, they can retain those right assets. It becomes more difficult as the needs are changing at an increasing rate and constantly. Higher ed doesn't deliver the education in the specific skills that the employers want to address those needs. This is sort of the shift we talked about from the four-year institutions of more general knowledge. Not that general knowledge is not good and useful. It's a great cocktail conversation. And learning to learn is an important thing that we'll talk about. But employers want their employees to hit the ground running. It's just too important. So, they want to have partnerships with the educational institutions to help get those assets right out of school. The individuals aren't getting a good return on their investments. So the traditional education isn't proving sufficient for them. And these things all fall into a bunch of categories that I look at where I see changes needed. And these aren't my own thoughts. They're generally accepted thoughts, although clearly there's debate on some of these, but it's no longer one and done. People need to have continuously learn throughout their lifetime, whether it's through programs provided by employers or they do it on themselves. Skills quickly become obsolete. It's the difference between perishable and non-perishable skills. Technical skills being perishable, students need to learn how to learn. They need to keep updating their skills. They need to expand their soft skills. Students are changing from being full-time to part-time, especially as professionals need to learn new skills. Everybody wants to match learning with earning. Otherwise, what's the point unless you have that luxury? It's a great luxury. Not everybody has it. The benefits of degreed versus non-degreed pathways, right? Degreed pathways aren't necessarily the right way to go anymore. Individuals need to build their own career credentials on where they want to go. And that, I think results in a lot of modular miniaturized offerings that become personalized, getting credit for skills you develop along the path, credentialing of things you learned at the workplace. And by the way, all of this at lower cost. Financing and debt is a whole different issue. And you may have seen in the last week, U.S. News and World Report has now built a debt factor into their college ratings, and it's very important now. Mm-hmm. Work-based learning and credentialing, micro-credentialing, unbundled, verifiable, stackable, portability of transcripts, not just between institutions, which is also a big issue. If I earn a credit here, can I use it there? But a transcript that you can take everywhere with your life experiences, not just education, but skills and what you develop in the work. Maybe that's a place for blockchain technologies, but that's really important. The innovative financing, like the income sharing agreements, being able to be active learners, learning and unlearning. We got to deal with equity issues, right? We have tremendous issues in equity, which carry right through the system. COVID's a great example, right? I've got 5 people in my house with 8 computers and great bandwidth, but not everybody has that. And that continues to create a learning gap, and that learning gap will accelerate into problems in the workforce. And it just keeps building upon itself. Better professional development, talent acquisition, recruitment, and assessment. A couple of the areas, so specifically, I'll mention 2 areas of this list where these technology really helping. And that's in assessments, continuous assessments, deeper assessments, and skills matching. And I think, AI is a great area to help with this. We have the data, although the data is not in all one place, and there's a problem of sharing data between businesses and governments and institutions, but the data is there. And we have the technology of the computing power. We haven't done a good job today of picking out those signals and really figuring out how to do stuff with it. But I think it's there, and I think it's ripe for innovation. I think it's a great investment area. And I think with those 2 areas, getting better assessments from the education and the workforce, and then being able to match the real skills, right? You can have 15 people called the same skill, but mean something else. Real skill assessment to be able to match with the employers will lead to better success. And I think those are 2 really important areas. And I know we're running out of time, but
No, I think you kind of hit the nail on the head with all of those pieces. So thank you for sharing that. And I have so many more questions, but I want to leave it open to the folks on the line. Heidi, do you want to kind of take some questions from folks?
If you have a question, just to kind of keep this in an organized fashion, please put it in the chat function, and then I will call on you, and I'll actually let you ask the question yourself. You want to give a brief, I call it a Twitter pitch, give your brief introduction of yourself and your company, your startup, and then ask your question, and that way he'll be able to put a face to a name when you ask the question. So please put any questions in the chat function, and then we'll start the process. And it's also been really great to see the activity and the networking that has been going on during the presentation. I think that everybody's adapting to Zoom and to the virtual environments, and it's been really neat to see how people have adapted to networking. That was a pleasant surprise today. So if you have questions, go ahead and put those in there. Give them just a few minutes. I guess I'll ask a question in the meantime, Michael. In regards to board of directors seats, things of that nature, does Shelter tend to take a board seat, or what is your involvement in that regard?
Everything is situation dependent. We are very active and hands-on, so we are happy to take board seats. I don't necessarily need a seat as long as I have exposure. I do want exposure, at least with the early stage portfolio. And what I mean by that is I'll take observer rights, or I'll have an agreement with the company that I get to see the board packages. I want to make sure that the right board is in place for the right company. And yes, we bring a lot of value to the table, and we don't want to be there just for the substantive issues about running the business, but the governance is also very important. So, a seat at the table is something we certainly consider. Sometimes we're asked and we don't want to take it for whatever reason. Something we didn't talk about was our constraint of human capital. We're relatively small, and we believe the big asset is the human capital, and that informs how many investments a year we'll make. Right? So our current portfolio may be about 20 companies. But on the active side, it's only a handful of those, because as they grow and we pass them off, we don't need to spend that much time. The board seats fall within that same equation. Do we have enough time to adequately do the right job on the board? If not, I'm going to want to make sure I have the same information so I can use it, understand it, act upon it. But I may not have the same responsibilities, because we take that board seat the responsibilities very seriously. And if we're spread too thin at the time, it's just not going to work.
Michael, I'm going to introduce you really quick to Stuart Halperin. So he's a longtime friend of our firm and an influencer in the entertainment and digital media market. But I'm going to, Stuart, if you want to go ahead and ask your question regarding technology that you're working with. He's still there. I'll ask it for him.
I got it. I just needed to unmute myself.
You got it? Oh, it's okay. Thanks, Stuart.
Hey, thanks for the opportunity to speak to everybody, and I appreciate the seminar today. I am running a new podcast network. I think I've told you about that, Heidi. It's called Kurtco, and I'm wondering if Shelter looks at media and entertainment opportunities, particularly podcasting.
So it's not what we spend a lot of time on today. We actually have a play in the podcast space right now. It's not an easy answer. I guess it would depend on some of the nuances and what sort of the thesis behind the company is. I'm not a big investor in content on the entertainment side. Not that it's a bad investment, but it's too subjective for the funds that we have. So if it's a content play, probably not. It's different than content on the education side. Content on the education side that specifically deals with curriculum, I think it has a different profile than subjective entertainment content. If it's a platform play with something unique to it, it may be something of interest. I'd have to learn a little bit more about it.
It is content, but we do have a competitive advantage in the luxury area based on the heritage of the company, because we used to own the Robb Report and a bunch of other publications. I've sent you a LinkedIn. If it's interesting to you, I'd love to hear back from you and have a chance to tell you more.
So, great. I'll take a look at it. Just, a little bit on the small description. I certainly can think of some people that may be of interest if you're not speaking with that you may want to speak with. So
I'd love any referrals.
Happy to engage in that.
And by the way, we're about 2/3 of the way through a $3.5 million round. So we'd love to close that with some great referrals.
Okay, so I'll take a look at the LinkedIn and we'll talk. Terrific.
Sounds great. I appreciate your help.
Excellent. So there's another along the lines. Michael, I'm going to ask this for Nick, just because it's along the same lines as what Stuart was asking. So you're solely looking at ed tech and workforce tech, or are there other industries that are fringe kind of industries that you're looking at that are fixing other broken, like technology that's fixing other broken industries? Are you open to those, to receiving pitches on those, or you only want pitches strictly from?
Absolutely. So we're predominantly focused on education and workforce, but definitely not exclusively. We have the ability to be opportunistic, as I said, in different places of the food chain, but also on the early stage side, we do other investments. It's maybe a harder hurdle today just because of where our focus is, but we've been doing this for 20 odd years in a lot of different verticals, and we're certainly going to consider any potential investment if we think it makes sense for us. And again, making sense for us is, is there a place for us at the table? Can we bring value? Is it of interest to us? Are there resources we have that will bear positively on this? So again, I'm not sure, Nick, of what space it is, so I'm talking in generalities, but yes, we certainly entertain other types of deals, and probably 20% of the portfolio today is of things outside of those two domains.
And I'm going to let Anna Araujo ask this question, but I think it's a question that a lot of early stage founders probably are wondering. So Anna, did you want to go ahead and ask your question about solo founder?
Yeah, thank you very much. I am a solo founder, and I find that most investors don't like very much when we don't have a team. However, my app is pretty simple. It's a subscription-based application. So I want to ask, like, even if the product is a simple product that like I want to expand like globally, but the app itself is simple, like, is it okay to be a single founder, or is it going to be like frowned upon?
Yeah, so I'm gonna answer with my thoughts, but I want to qualify that I don't know enough about your business or your product. So the generalities, I'm going to say, I don't want it to be taken personally. I'm going to be very careful about that. One thing, a single founder, these early stage businesses are very, very hard. There are so many aspects to it. No matter how skilled you are and no matter how much of a utility player you are and able to wear a lot of hats, there's just so many hours in the day. If you came up with a company and you told me this company was able to add hours to the day, that would be interesting. But there are only so many hours in a day, and it's really hard for one person to do everything very effectively. But you mentioned it's a simple app. So we typically would not invest in a simple app. That's a product and not a business. And the reason you may, as a solo founder, be able to adequately handle the single app business is because it's a product and not a full business across the board. And that would not be of interest to us. It's not to say that for an individual, it couldn't be a good company and couldn't be a good lifestyle company, but it doesn't sound like it's necessarily a company that would be needing venture funds. I could be wrong because I don't know a lot about what you're talking about specifically. It could also be that today it's a single app and you can handle it as a single person, and that develops into a business with multiple products, and at which point you recognize that you can't do it yourself, and then you become a business with a team that may be more financeable.
Okay, thank you.
I'm going to let, this is actually going to be my last question to round up the event for us today, but I'm going to let Nick Blake go ahead and ask the question regarding contact method. Nick, do you want to ask?
Sure, thank you so much. And Michael, thanks for a great presentation today. It's very exciting and informative. I get to follow up from my earlier question. What's the best method to contact to follow up?
So my email is great. You can obviously just remind me in the email that you were on this and that we communicated. It's M as in Michael, Rotgin, and probably got the spelling from one of the distributions that went out, at sheltercap.com.
I just put it in the comments section, actually, and somebody else did too. So, and somebody had asked about the recording. So we really appreciate everybody being here today. We're going to wrap this up. We did record the session today, but with all of our investors for regulatory reasons, we have to have them review it first and look over that, and if approved by Michael, we will post it to our YouTube channel. The Stubs Alderton Markleys has a YouTube channel with past Investor360 events as well as a host of other investor content, and so that would happen in the next week or two. So stay tuned for that, and it was really great to have everybody here. Next month, so the third Wednesday of every month is when we host these. Next month we will be hosting Michael Tam of Craft Ventures. So look forward to seeing everybody then, and thank you so much, Michael, for joining us. This was really, really informative. I appreciate it.
Thank you. I appreciate the time.
All right, we'll talk to you soon. Take care, everybody. Have a good day.